Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, February 15th, 2024. It's 10:30 a.m., exactly 1 hour into the trading day, and I figured I'd just get a quick one out. And when I say a quick one, as you guys know, they usually go at least 20, 25 minutes, but I just want to go over, I like to, from time to time, just catch up on the most recent questions, and there's only a few here to yesterday's post, so I'll address those, or questions and or comments on both. And then just kind of again a quick recap overview of the equity markets and trading in general. Let me just start with I just fired off an update on the silver trade, and this is and again I try to beat the drums on the benefits of diversification when whether you're swing trader or day trader. Well, day trading kind of different in and out, but for swing trading, trend trading, and investing, very important. And in diversification, this is also very important because many don't realize this. Doesn't mean you have 5 or even 10 stocks in your portfolio. If you own Amazon and Apple and Meta and Tesla, you own the Mag 7, you own tech-ish companies, whether they're categorized as hardcore tech, they're in that sphere of tech, mega tech companies. And they move together, and they're also one asset class. They're equities. The stock market ebbs and flows, and on any given day, some are up and some are down. But on strong days, you can look at the Nasdaq 100. Simply look anytime the Nasdaq 100's up, over 2% or down over 2%. You're going to see almost all of the components. The vast majority, 70% or more down. That's kind of a given. So just remember that having a lot of stocks. Now, if you are, in sectors that have very little correlation or even inverse correlations to one another, that's some diversification. But the big part of diversification also is asset allocation, having different asset classes. Silver, even though we're trading an ETF, but it's tracking a commodity. And so my point is that this is, a couple points. And let me just roll into there. So we hit that, there were 2 entry points, and the first trade was thrown out here on that divergent low, and you can buy it here and/or means a scale in. You can either wait for a pullback to the full support of $20, very good support. In which case, if you bought that yesterday, you're up 5% in one day. And it's also a offset. Again, I need to reiterate, we had a sell signal the other day on QQQ, and I'm going to get to that here in just a second. Well, let me roll into that. And so just remember, if you are short the Qs, positioning for a trend line break, waiting to add to a position. Now, some of you may have covered the quick pullback because we hit the initial target the other day, which was the primary uptrend line, and I stated active traders can cover and go long there. But if you are still short and you own silver, let's just say, then it's more than offset any upside in QQQ. So you've actually net, on just these 2, that's not a diversified portfolio, but it's an example, then you're profitable there. Likewise, IEP is obviously a stock. This is Icon Enterprises, Carl Icon's company. And but when you look at the chart, it's almost inversely correlated to the stock market. This one's just coming off 52-week lows, especially big tech, which is most of big tech's at 52-week highs. And so as you can see, there's a very little, if any, correlation to the stock market on this one. So although it is not a different asset class, it's an uncorrelated stock. And, of course, if you took this one as well, you're up 10, 11% right now on it. So again, it's and I say this because 99% of the comments I get are about the equity market. And given I do the majority of my coverage there, because that's kind of formulates the big picture, it's easy to trade. But just keep that in mind, and whether you're finding your trade ideas on your own somewhere else, just remember, spread it out. Don't put all your eggs in one basket, folks, and you should over time do well. It's the same premise again with investing in your 401k. Asset allocation, different securities, small, mid, large caps, international stocks, bonds, commodities, if you can access that, stuff like that. Okie dokie, back to the charts here. My clean boards. Remember, Again, we have these primary uptrend lines, which will trigger not only the next sell signal, but a more powerful sell signal. The one that we had recently, we caught the biggest drop in, what was I said, almost a year. I forget what it was. And that was just a 1 day, and it hit again on the daily time frame, which is more significant for swing and trend traders and active traders. It hit and closed on, never lost support. That was an intraday morning post opening pop, and we traded on, went up, and you had a tradable bounce, which I talked about trading there, and closed right on there. So that's it. So to reiterate, there are no sell signals right now. There was one the other day for a short term, and again, if you are positioning, waiting for a break of that, that's what I am. I hope, and swing, in my swing accounts, I have some swing positions. I think it's going to go. I thought there was a chance we could get it today on the economic reports, and we are down. And I think I think a break of this trend line is likely and imminent. Okay, and there are no guarantees, but that's what you pay me for, to analyze the charts, and then it's an extra bonus. I'll tell you what I'm doing and what my thoughts are. I'll tell you, here's the key levels. You can trade them opposite the way I do, as I say many times. If you're a bull, and lately we're getting a lot of vocal folks out there, and hey, I wish you well, more power to you. If you're bullish and you can think this market's going to continue higher and you're in that buy the dip mode, that's what the value, if you're only trading the indexes. Again, if you're taking the other trades, you're doing very well. And if you're only trading the indexes, at the very least, recognize these are the key levels. It was identified and harped down as a major support level before we even hit it. And you can see we've tested and bounced off it every day so far this week since we fell to it. So again, you can buy the dips if you think we're doing that, or someone who believes that this is going to break down and wants to get short or shorter, for lack of a better word, will wait for a break of the trend line. And the way that works is, if you're trading a typical swing or trend trader, you can do one of two things. You can take the next break. I think the break, as I've been saying, of the recent lows, as well as those Meta and Amazon. I want to see those lows taken out, and I want to see SPY taken out. I'd put a very high probability if you get intraday breaks, especially below of the trend line, but especially below those recent lows, that's going to stick. And if you want to even increase your odds further, you can wait for a solid daily close below the trend line. The only problem with that is if it's as this trend line becomes more and more defined. I consider a trend line well defined. If it has a lot of reactions, it becomes more obvious to most. Maybe some didn't see it until recently, and we have another reaction, and now some people are stitching these lines together, or they're following my analysis or someone else and say, okay. And so that's the way typically technical analysis works. The better defined a support or resistance level, the more likely it is to trigger a more powerful buy or sell signal if and when taken out. Okay, this is an uptrend line, so obviously you take it out, that's a sell signal. And on a downtrend line, you take it out, that's a buy signal. Okay, so that's that. Simple stuff. We're above it now. No sell signals on the, at least not on this trend line break. And there's SPY as well. Perfect. I mean, I haven't touched this thing, and you can see how well that was the post-opening, downside momentum, order imbalances, parked on it there, but we even had an intraday rally, hit it again yesterday at the lows, bounced, and we're above it. It's one thing to sit there and just give you levels to watch, but it's, everything else in the charts, including but not limited to the divergences, overbought conditions, breadth deterioration, and other things that make me feel confident enough that a breakdown is imminent to carry, at least at this point in time, in swing accounts with ETFs and things that I have, where I don't want to miss a gap down. I have a starter short position there, which I will add to pretty significantly if and when we get these additional sell signals. So that's the recap. But now let me just talk on the comments here. Okay, a little cynicism, but I get it. Bulls were so rattled that they've retraced 100% move down on NQ from the CPI report. Yes, but it's also it's about just a run of the mill 61.8 retracement. It's a hair over. I already here. I'll just put it up where you can see it. You put up Fibonacci lines. And put it up there from that low to high, and there's the 61.8 right here, this blue line, 61.8% retracement. That's probably about what we hit in SPY. I didn't check it. And that's just if this is the start of a new downtrend, and we are going to go into breakdown, that's a run-of-the-mill counter trend bounce. And again, I'm going from the highs, and yeah, their point was from the CPI report, but that was our our sell signal. We had that break here. That's where we got short, gamed it down to there, and this is where I said where we hit the trend lines and price support as well. Remember when we undercut on that morning the trend lines, we hit very good price support. This is just my 15-minute chart we're looking at here, but there were a lot of support levels there. And so again, I went long there. I covered shorts and went long as an active trader in my active trading account, and others could have. And so I don't know. I'm probably spending too much time on that comment. It's a bounce off a major support level, a bounce that I 110% expected to happen. The big question is, where do we go from here? So right now, well, a couple things. I'll speak to that. As I said yesterday, I believe it was yesterday, and I'll get to IEF in a second, as long as IEF remains in my yellow zone, which we back tested the top of, we're still in there today, you can view bounces, especially into resistance, I believe that's how I phrased it yesterday, as objective short entries or add-ons. But I will say they're aggressive, and I'm trying to frame this properly. And let me be clear without any confusion. Again, the highest probability sell signal will come, especially for swing traders. I speak on active and swing trading, but for swing traders, yes, the highest probability sell signal is going to come on a break of the trend lines that I talked about, and a break of the lows, recent lows on Amazon and Meta in particular. I want to see that happen. So SPY, QQQ, Meta, Amazon, right? The lows from the other day. But for more aggressive and or active traders, as long as IEF remains, even if you're scaling into swing shorts, there's two ways to do it. Wait for a break of support, or short a rally into resistance. Now, until we get the more significant sell signals, this strategy, shorting into resistance in anticipation of a breakdown for a longer term trade, is more aggressive. It's counter trend. We don't have the primary or intermediate trend signal. Sell signals haven't triggered. That's the break of the October trend lines. That's what I call the intermediate term uptrend line. So that's that, but you can do that. And had you done it here, that's a nice support level. That's 17,928. You can see we had a little breakout here. Qs rallied to highs, new highs, back tested it successfully a couple times, hit it, back tested, and then broke down right there. And that was our, I have to look at the 60-minute chart. I can't remember if that's where the 60-minute trend lines broke, but either way, that was a hot CPI print. It's a quick trade. Again, one of the biggest drops in I think almost a year, at least in the Dow, is if I read correctly. And then we hit support. We hit price support. We hit trend line support. And also you can see my lines here. It's a 15-minute chart. So this is the realm of the very active trader. This is not the long-term swing or trend trader or investor in a 401k. Ignore this stuff. This is just, if you like gaming these little ups and downs, like I do, this is where you go long, short. You can even see right there when we hit it. Again, I posted going long there and covering shorts at the time anyway. But you can see I didn't have this chart drawn up. Sometimes I'm going to look at these lines, but that was my plan to cover that trend line anyways. And there it is. So you had positive divergence there. So it's simple stuff, okay? And now you had negative divergence here, and you just broke down here, and that is a sell signal in the 15-minute chart. I always say divergence in itself is not a buy or sell signal. Negative divergence is not a sell signal. It's a condition that can continue to build. And so then the ingredients, what you need to see is a break of support, and then you short. Then you look for your targets, and especially all the better when a target's hit, which is usually a support level. and you have positive divergence, even if it's on the short-term time frame. And again, some of you might say, Randy, we're talking 1, 2, 3% moves. To each his own. Do not, if you're new to this, don't start diving into leverage products like futures and leverage ETFs, and cut your teeth on the non-leverage ETFs, paper trade. But I like to trade futures, and there's a lot of juice in them, inherently. And if you trade futures, NQs, RTY, ES, whatever it is, stock futures, they'll give you enough rope to hang yourself. So you got to be careful with it. But, if you can game these micro squiggles, you can make a lot of money on just the one. Even again, it's all mathematics, guys. Just look at the leverage factor on the ETF, see what the net exposure per contract of NQ is. Or you can do it with QQQ. The only thing is a broker, I think, what is it? It's like 4 to 1. So if you got 100,000, I think they'll only let you, leverage up to 400,000. And again, that's if you did your whole account in QQQ. I believe that used to be when I was a broker, the leverage ratio. I don't know if it's still that now. Futures are quite a bit higher. You know what it does too, by the way, the leverage factor also allows you in a portfolio of whatever that size is to make those larger sized, leverage trades. But then if you're offsetting it, let's just say, for example, which is me, I just sold my silver tab in long silver coming into today, for the reasons I've been showing you lately. Took book profits at that target. I just did a reverse for a quick pullback. Here, I'll get to that. But, so you can then take a portfolio of, let's just say, whatever your number is, $100,000. And you could be trading 500,000. Now, if you're doing that and you're only trading NQ or silver or whatever it is, Bitcoin, on any given day, you're going to be very happy, and on some days you're going to be very unhappy, and eventually you're going to go broke because your trades are going to go against you. Nobody bats 1,000. You're going to have a surprise trade. So you could then take, 100,000. You can diversify it among uncorrelated, even inversely correlated assets, bonds, fixed income. You've got, again, futures there, leverage ETFs, however you want to trade it, or just simple margin. There's something to be said about not having everyone's addicted to these leverage ETFs. The way a broker is going to work, if you want to buy TQQQ, the 3-time 300% QQQ, your broker is only going to allow you to buy a third of that on a margin account as they would on QQQ. So you can leverage up the same amount. You're just buying 3 times the amount of QQQ, but you're burning the same amount of buying power. I'm probably getting too much into it. If you guys don't know about how margin works, don't worry about that for now. I mean, read up on it, but stay away from it if it's not your thing. So, all right, guys, there it is. SPY. That's where we're at. You go down to the shorter term charts. And again, you can, I've not been trading SPY, so don't have this marked up. You can see this most recent divergent high. I did have a trend line there already. I didn't even plan on getting to this chart. I happen to be on the 15-minute time frame. So there's a sell signal. So this is active trading. And then right here, you put in a little small, just like I showed on what was it, QQQ a second ago. This is a 15-minute chart of SPY. The ETF, there's your little divergent low, there's your bounce, and there's a gap. Traders love those gaps, so that was an objective. This is what an active trader would do. They would have been long up here, short at the break of the trend line. There was price support there. It's a good place to cover. You had positive divergence, you bounced, you backfilled the gap, and now there's a good chance we go down. If we don't, then that's near-term bullish. If they take out the gap by a fair margin, go up, we're probably going to punch through new highs, and then you have to just look for the next setup. At that point, this was a point to go long. If we break out there, me personally, and again, I'm just speaking to SPY, I'm not trading SPY, but if I were to have shorted there, I wouldn't necessarily go long on a pop above. I would cover somewhere, and then I'd just wait for the next objective entry, which could be one of two things: either pull back to support if it looks like it's going to continue on up, or the next short setup, which come down the road and start to look at trend lines start to form, horizontal price and support levels, just maybe another divergent high. If it happens over that level, there's not going to be any resistance to short into. You don't have resistance on the security at new highs. Remember that. So then you have to look for other reasons to if you're going to short. All right. Here's a good one. And this prompted me to do the video. I started to mark up a chart and reply, but I think it's just going to be easier. I'm just kind of in lazy mood and somehow feel like better to cover this in a video than because you put the charts up. There's some small nuances here that might be harder to see if I screenshot the chart, which I started to. So it's a great question. You mentioned Amazon weekly divergence, but failed to acknowledge the weekly RSI divergence got taken out. What am I seeing unless I'm wrong? No, you are not wrong, and it's a great question. I want to bring that up. First and foremost, and most importantly, I talk all the time on when I'm talking about always say that an index is simply the sum of its parts, right? So on the NASDAQ 100, you have 100 companies. However, that's not even as accurate anymore. On the NASDAQ 100 equal weighted index, it is a sum of its parts. It's that easy. On the NASDAQ 100, it's a market cap weighted index, and it's far from true. Almost half of the returns are just the Mag 7. So it's a market cap weighted sum of its parts, if you will. And so then you have to look at those. Where I'm going on that is I often talk about how I look at those collectively. So Amazon is only one. And so let's say you have divergences on all 7 on the weekly chart on all the indicators. But then all of a sudden one of them takes out the divergence. That doesn't mean the whole case that trend reversal is likely coming is wiped out. Not even close. I see that all the time. Again, I look at those collectively, and I speak to that too. You don't want to. Sometimes I won't take a sell signal or a buy signal on QQQ if I don't see concurrent breakdowns or breakouts. Buy or sell signals, depending if I'm bullish or bearish on the majority of the things. So that's what I look at. And so I take it collectively, and collectively they have, I'm going to jump over here to a weekly chart. So collectively they do have divergence. This is SPY, but let me go to QQQ so I can load the components. This was, remember, I had this line here a long time ago, this orange line here, maybe you don't remember. So I've had these lines way back when well, I just touched it now, it changes the date, but I created that back on September, and I created this one back also, I believe, September 11th. And these were before we even made new highs. They were what I call scenario lines where I could easily see new and much bigger highs. So I'm going to color these up a little so they're a little more visible. I'll just whatever, we'll leave them, we'll just make them orange. They're already orange, but I have a darker, it's like a dark color there. So you can see them now a little bit better, and then this one's orange. Now I know this is what I call a busy board. There's a lot of lines in here, but it's my primary board. Same one I've been covering since the NASDAQ peaked back here. So this is that marginal new high scenario I've been talking about now for almost a year, going on quite some time, and saying that if we broke out, it would be, and it's a marginal new high would probably be it, and then followed by a sell signal. And there's the trend line off the October lows. So it shows through here on the weekly. So it's a pretty significant trend line. In fact, it gives us a rising wedge pattern here. There's your uptrend line. And this is you have divergence. If you only want to look at it from this point right here, from this high back here, and that was about August or so, July or late July, early August of 2023. From that point on, we've been diverging, and as I stated, it would be back at that time that if we go on to make that, what at the time was my alternative scenario, a marginal new high. And again, it must stay a marginal new high. If we keep going up, if the bull case is right here, we're going to take out these divergences. We're going to take out the divergences on the FANG, and then I can sit here and talk all day long about how I still think things are going down, but I can't make an objective case. That's just going to be outright, confirmation bias or denial of what's going on. So, and that may be the case, guys. Again, I'm not going to certainly ride out a short, on the NASDAQ 100 for another 20-30% upside. But as of now, this is exactly what I could see playing out, and it's playing out, but what we don't have yet is the reversal. So this is what I call potential divergence, not confirmed, because these indicators right now, they're at lower highs, but it hasn't rolled over yet, and they're momentum indicators. They're still pointing up, at least on the PPO is the one I really look at, and I like to see a bullish crossover to effectively put in a lower peak below the previous peak to give what I call confirmed divergence. So we don't have that yet. If and when we break this trend line, I think there's going to be a pretty quick rush for the exits. And it's a weekly chart, so you're going to have to wait till 4 p.m. on a Friday. It's not going to happen this Friday. Very unlikely. Could be next Friday, or it could be 20 Fridays from now. As long as we don't do this first. We don't just continue on up, get way up here, and then break down. And look, even if we take the divergence out, guys, I've seen that quite a few times. It's not the most common thing, but I've seen divergences get popped briefly, and I've seen a lot of it recently on a lot of high-flying techs, and then they reversed. It's just what happens in a strong Momo market. Momo meaning momentum. Okay, let me show you something else here. So there's QQQ, and again, this is bigger picture. This is the stuff that shows through on the rare monthly charts. So you don't see me talk on very often on the monthly time frames, because it's just things develop over such a slow period of time. But we have that big divergence on the weekly. You can see it clearly here on the monthly right there. So we're below, these trend lines. But let me get back to Amazon. Let me do that real quick, because I'm getting off task here. All right, so what I'm looking for on QQQ, you see the technical posture. I'm going to go to my main boards on Microsoft. There's an uptrend line off the early 2023 lows, which on the weekly is pretty significant to me for Microsoft. The 200-day, aka 40-week moving averages are below that. You can see I kind of have a scenario line drawn. This is, nothing's changed from back here for me. We hit my first target. I can't tell, did T2 get hit? No. So T2 is my next target, 197. And I think we're going there. I know very few believe that. Very few, not just listen to my voice now, but out there in general. That's a 52% drop. Not going to happen today, tomorrow, next week. Could be this year, possibly. Things get ugly before the end of the year, but or next year, if not. And again, big divergence building here. And so the divergence is intact. Here's my point I'm trying to make on that Amazon thing. So Microsoft still has, you can look at it just from this point to this point. Actually, no, if you do there, it took out the RSI divergence, but you have the bigger, more significant divergence that's been building. And again, that shows on the monthly chart. That's why I have such aggressive, targets that many think are probably just insane, calling for these drops of, 50% or more in these market leaders that just seem invincible at this point in time. And all I do is I look at history. I go back. It's happened before. It's going to happen again. In fact, the more you get disconnected from reality, the more conditions form. That's where you're going to get. The old saying: the higher they rise, the harder they fall. That kind of thing. That tends to hold true for any asset class in the market. Okay, so. Those are the targets. But I just wanted to point out the divergences are still intact on the majority. And again, that's what I'm trying to get to here on Amazon, and I'm kind of going the long route to explain it. There's Apple. I know this is a busy board, and all I can do is turn off the lines and draw them for you again. Let me squish this down so we have a little more room to play with on price. Again, we've been diverging. I zoomed in, so it may not look, this is, you can zoom way out, but I've zoomed in here in the lines that I had on that other chart. I just wanted to turn it off because it had all the price levels and it looked busy. That was a divergent high right there. That's where I called, the bear market we got, and Apple and everything else dropped down. That was certainly a divergent high, and it took months, almost years, almost 2 years to build. It started building from right here in mid 2020, and then finally started playing out here. And so what we've done in Apple, like so many others, made a marginal new, meaning a relatively slightly higher high. When you look at the whole big picture here, and all it did is extend the same divergence. This was our peak back here. Prices are making higher highs with these indicators not making, and they're making lower lows. That is negative divergence. And Apple so far has peaked back there. You can't declare it dead yet, but I can tell you definitively, even if you look on the shorter term right here, you had right here, you have a smaller divergent high as well that was recently put in. So I can go through them all, or you can take my word for it that almost all of them have that divergence. So I'm getting to Amazon here. I'm getting to that question because it's a good one. There it is on Alphabet. So again, collectively, there it is on NVIDIA, divergence, what I'm confirming. And so we get to Amazon. Okay, and so this wasn't me trying to be dismissive looking at this. Yes, we do have, when I draw that line there, if negative divergence can come on prices making higher highs if the indicators are making obviously lower highs or equal highs. That's negative divergence. They call it flat line divergence, some refer to it as, but you don't have higher highs in your indicators, especially, and you look at the scope of the move. If prices are much higher than that, that's even more pronounced. So yes, if you want to really squint and look at it, you don't have to squint too hard. The RSI made a slightly higher high. But again, my point being, collectively, the vast majority, almost all of the Mag 7, maybe except this one, have clean divergences on both the indicators. And there's other indicators, by the way, a lot of other indicators I use. Some you can see on this chart. I have on different boards. Another one, you can put up things like the PPO histogram. You can see the divergence there on Amazon. Very clear divergence. So roll back. That major high right there, remember Amazon fell, doesn't look like it a lot. I use log scaling on my charts. High to low, that was a 56% drop. You would have lost over half your money in Amazon if you didn't heed those. We were short, short the market. Gaming counter trend bounces, gamed the two biggest went long here a couple times, once or twice at least on that bear market rally. It was well into the double digits, and then picked it as my favorite back there. Long again. And that was based off things such as the bullish divergence. But let me show you something now. We'll zoom in. So I don't have all the PPO divergences, and there's other indicators you can use as well. But you can see lots of divergence on a lot of different indicators. And yes, absolutely. Good point that the RSI divergence is taken out, but ever so slightly. And in fact, that's pretty common. Let me show you. Let me expand these divergences again. The indicators, so we can look at them. So back here, and again, you can reference this on the site. We were long there for other reasons than this weekly. It was support, and we were long there, covering and going long there. And part of that was you can see the strong divergence here on the RSI, but yet on the PPO, look at how the PPO made a slightly lower high. I'm going to put this, I need to make that trend line perfectly level. To do that, I just put it on another line like this. That's how I make sure it's level. Again, you're splitting hairs if you really have to say, is that line, for all intents and purposes, it's almost an equal low. However, if you look really closely in the video, you should see it didn't. So that was not, it's what I call an ADL, at least on the PPO, almost divergent low. However, we did have divergence on the RSI, and I'll bet you if I threw up other indicators, there was. And it was, to me, more importantly, we had divergence on the daily time frame, and we were at very good long-term support that I've been calling for that 83 target for all the way from way back when. And so we hit it, and there's a case where you almost had divergence, was slightly taken out. In other words, you had the positive divergence right there. That's how the lines would have been drawn, and then would have been flat to right here. I would have lifted that up. And so you ever so slightly took it out, but then reversed. So, all right, I think I made the point, but I'm going to show you one more back here. This was, here, let me take us back in time a little bit and go like this. So you can see here, this was the fourth quarter of 2018. We nailed that down with impunity, called the bottom. I predicted a pivot in the Fed. Treasuries, that was when the Fed tried to first start hiking rates. And I said the market would throw a hissy fit. We went long Treasuries and covered shorts there. And Treasuries then exploded because the Fed turned around and pivoted. The market screamed and cried foul when the heroin addict tried to take the doctor tried to take away the heroin from the patient, and that was a big drop in the market, and Amazon dropped 36%. So in just a matter of just a couple, one quarter, a third of the market cap of this company got wiped out. And my point now is, you can see here, you got it, negative divergence at that high. There was your sell signal on the trend line break. And this one right here, look at the same indicator right now. The RSI made an ever so slightly higher high. You can see it here. I'll zoom it in. See that? Take it down there. And so it didn't mean, oh wow, the case is over. Remember, divergence is kind of, you don't have to take it super literally. It's just it's a momentum. These are momentum indicators. So they're showing you whether prices are going down and the indicators are making higher lows, or the other way around, bullish or bearish divergence. It's kind of just it's showing you momentum on a trend is waning, trend's getting long in its tooth. Nothing goes up forever. Even in a big bull market, there's always going to be corrections. These are just corrections so far. This was 14%, 36. And as a swing trader, if you're an investor, it doesn't take a rocket scientist to say, put all your money in Amazon, 15 years ago, 20 years ago, and just leave it there. Yes, the trend is up, but that's not what this site's about. You don't need me to tell you over time, if you have a 50 or 20 or 50-year time horizon, you're going to make money in the stock market. Don't waste a penny on a subscription here or anywhere else for someone to tell you that. As an active trader, I'm trying to game these squiggles, whether they're up or down. And again, it's not all down. It seems like that lately because I'm seeing a big picture. I'm seeing what I believe to be a lifetime opportunity to not just short the next big leg down, but to game these counter trend rallies, these bull markets as well. And I think in the coming years, we're going to see a major secular bear market. I compare it a lot to the Japanese Nikkei index, which just recently, it's been in the headlines, it just punched through new highs that it put in back in 1989. It just finally took those highs out. Guys, think about that. For 30 years, you've only lost money if you held, and you've only now gotten back even if you bought those highs back in in 1989 in the Nikkei. Again, if that's where your money was, and that is not adjusted for inflation. That's very important to say, because if you had 100 grand back then in 1989, 1990, and you invest in the Nikkei, you now got your 100 grand back. You get a little bit more, but that 100 grand won't buy you squat compared to what it used to. So that's the importance of this, and everybody's just resigned themselves to the fact that the Fed has finally figured out, after all these years, all these decades, it's been around almost 100 years, they've finally figured out the secret to prevent any future recessions. They've canceled the business cycle. For those of you that are not familiar, the business cycle is a natural. It's like the seasons. The 4 seasons we have. As the sun revolves, or the Earth revolves around the sun. Spring, winter, summer, fall, and the business cycle is not only a natural part of the economy, but it's something that's been severely altered with and prevented ever since it really started after the dot-com bubble burst with the excessive intervention, monetary, artificially low rates, but then just went kind of all out crazy after the financial crisis, 2008, 2009, and then when COVID hit, forget about it. And what it's doing, for those of you that know business, study business, the business cycle is absolutely necessary. It's just like prescribed burns that the forestry department does here in Florida, out there in California. If you don't burn down that undergrowth from time to time, you're going to get just ultimately this huge fire that takes down all the 200-year sequoias and everything. They all get burned down with it. So and when you keep companies alive, when you don't let the recessions come and wash out the weak companies, it makes it hard. I've used the analogy: if you sell widgets and you live in Anyville, USA, and you're a 3rd generation widget company, your grandfather started it, and now you're running it, and over the years, maybe there's 1 or 2 others around town or in the area that sell widgets, but now there's 20 widget companies. Because they're all just kept afloat. It gets to a point where it makes it almost impossible for all those companies to make money. And the ones that are well run and financed and managed can't compete with those that aren't as well managed, that are underbidding jobs, not making, not running the business properly, but yet in the right environment, and you can keep that going. So we have that. We have a lot of zombie-ish type companies that are just being kept afloat, or have been for decades now, with excessive low money, and then every time there's a blip, stimulus coming in, and again, it's not healthy, and it just leads the way for a bigger drop. So all right, I went off a little bit more on a tangent, but I hope that makes sense. The fact that, yes, I did want to address that. It's a good point, and I didn't miss that on purpose. But again, collectively, when all the Mag 7 have started, and I can't make this case anymore like I could back here. And I was, making for a while there. But you can see there's certain things. It takes these powerful sell signals. This was a trend line on Amazon here. There was a break, big red candle, back test, rejection, and this box. And you had 2 false breakouts to new highs. I can promise you back then, the bulls were every bit, probably not even as giddy right now as they were at this point, these 2 breakouts to new highs. And then you see what happened. And those came with, as I often say, breakouts that occur with negative divergence, which you had at that point on the first breakout. Failed, went up, tried it again, made the divergence even larger. Then it became clear to the bulls, or just market forces. It's market forces, guys. I speak of bulls and bears kind of metaphorically as buyers and sellers, but these are market forces. Then a trend line got taken out after the failed breakout, and like I said, back tested. Then that the box is right here. This is the box. I'm talking this trading range. Once that was taken out, that was the nail in the coffin. And this is the beauty of technical analysis, because it lets you have this precise timing where you watch CNBC. Most of these folks are just speaking kind of vaguely, long-term outlook, price targets. But here I try to pinpoint where to get in. So I may talk a bearish talk for 2-3 years, or a bullish talk for 2 or 3 years on something, expecting that move. But then the important thing is, when does the timing come? And again, the timing is not any one singular event. It's often a series of events. So right here, we look at Amazon right now, since I'm on that. Well, let's see what we see in the charts. We see this cleanup trend line that comes off the October lows. No mere coincidence. A lot of these big market leaders have this. The indexes have it. Key sectors, the semiconductors have it. And we have, is that a bearish engulfing? Yeah, you only have to engulf the body of the previous candle. The body is the fat part. So if I look at the highs of that candle, that's where pretty much this top of this one comes. As of right now the week's not over, but we're down here. We have a bearish engulfing candle. That's a pretty decent chance that if we get that, that could mark a top. But again, the highest probability sell signal will come on a break of that trend line. And then if you're just a trend trader or a typical swing trader, and you don't want to mess around with all these squiggles, zigs and zags, and remember, I wouldn't short Amazon unless the majority of the Mag 7, and especially NQ or QQQ and SPY breakdown. But if so, here's where we're going. We're going to go down here. We're going to hit these 200 days, which come in. We'll probably, from my opinion, we'll probably overshoot the 200s briefly with a lot of downside momentum. Hit this trend line. I might have to add, tweak some of these levels. Yeah, I'm going to do that. I'm going to put a line right here. I see good support. There it is. So here's where we go. Trend line break should take us down to about 144.50, give or take. And if things get ugly and we shoot through there, then you have this uptrend line, you have the 200 days. This whole area, it's just we'll call it a target zone. And that's calling for a drop of off the recent highs. Let's just say that's going to be about 17 to 20% in Amazon. But guess what, guys? If 6 months from now we're not there, and you bring up, hey, you said we're going to drop 20%. No, I just said we're going to probably drop 17, 20% off the highs from if this trend line is broken anytime soon. Now, if we fast forward in time, we go like this, and then we just keep walking up that trend line, especially if divergences are taken out. well, then it kind of resets that call. That never happens. So another way to say it is we'd have to break down to keep things intact, ideally, relatively soon. I'd want to see that breakdown on Amazon and most of these market leaders take out this trend line within the next, I'd like to see it happen this week. It'd be great. But it would really need to happen within the next month or so. It's hard for me to say exactly these are monthly candles. Maybe we can go on a few more months. But if we don't, if we keep going higher, now if we go sideways, remember, these indicators will actually turn down. A lot of folks don't realize that, because when you're going up, if you stop going up and go sideways, you've lost momentum. And so you could see that happen too. And then these indicators, you could get the bearish crossovers and all that on the PPO. So there's a lot of possibilities. And again, I speak in probabilities, what's most likely. And if I've said it once, I've said it 1,000 times, even in this video, we are pending or waiting for potential sell signals to come, which haven't yet come, but appear to me likely and imminent. So, it's whether you want to take a partial position in advance, whether you want to buy the pullbacks to support. And remember, the two that I harped on recently were Amazon. It's got that big old gap, and Meta has a big old gap. And so probably when you take out, this 167-ish level right there, that'll probably do the trick. But if you want to play it safe, as I said 2 days ago, and again yesterday, and again today, the recent lows, that's from Tuesday, on everything, on QQQ, SPY, Meta, and Amazon. And that's it's not a guarantee, it's just what I call a high probability sell signal. Okay, to wrap this video up, just a quick overview of all the indexes. There's SPY, there's our primary trend line, the one I've been harping on. QQQ, same one, trend line's off the October lows. We're close, no sell signal yet on that one, or SPY, or Meta, or Amazon. But then it's not just those guys. You look at the equal weighted NASDAQ 100, that one's already broken down. The equal weighted S&P has just stopped going up completely. It's been kind of, it's got this big divergent high, but the trend line isn't really, this was the trend line it had, broke down, and it's kind of been moving mostly sideways. And again, that's a function of the fact that fewer and fewer stocks are going up anymore, just the big mega caps. And then you have the semis. Semis need that same trend line right here off the October lows. This is SOXX. It's not the only semiconductor ETF. SXD is one, but that one stalled out too. Again, it depends on the weightings that they have. They all have different compilation, but this is SXD, still above its 2021 highs. That's one semiconductor sector ETF, and then SMH. So the ones that have, this chart that looks similar to the NASDAQ have that high weighting of NVIDIA and the big tech stocks. Primarily NVIDIA. NVIDIA is a big part, but there's other ones too that are doing that. And then I go through them all. I'll have to do that in another video. I've done that recently. So there's the semis will almost certainly follow suit. And again, if you want to put the odds high, wait for the breakdown. If you want to short the semis, if you're not already short, or if you're short looking to add on, there's a first stop right there, first target. But again, you need to see this primary uptrend line off the October lows go. Take us down there, take us down to this point, and or we continue higher for a while, and then 2 months later, I'm still talking about these trend lines, except we're up here. Okay, so that's it. No sell signal yet on that. But yeah, we did have the bearish engulfings here that got taken out, so that's no longer a topping stick. I mentioned that. You can short that if you wanted to, with a stop somewhat above. You may have been clipped there. It's been a tricky market, but we're right back to where we put in those bearish engulfings. So technically, that's no longer a topping stick because you put in that little doji candle there. But really need to see this go along with the other major indexes. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.